They don't want you to scalp like this, because it's simple and it works. In this video, you will learn how to find these setups so you win trades like the one you see on the chart, explained step by step, so pay close attention and let's get it started. We're going to use the 15-minute time frame a few minutes before the US session opens, and we're analyzing the market to understand the trend it's been following recently. If it comes from an uptrend, we'll see a higher high with a higher low. After each higher high, we'll mark the break of structure, and the higher lows should not break as long as the uptrend is respecting. Now we're seeing on the last candle that the market is trying to pull back to the downside. However, it should form a low that's higher than the previous one, which should be then followed with an upwards push to break above the last high. All of that because it's simply just an uptrend continuation. So in the 15 minutes time frame, buys make more sense than sells. Now we're moving into the next step. In this step, we need to mark the US session open, which happens at 9:30 Eastern Time. You can convert this into your time zone, or you can move into TradingView or any charting software and set the chart time zone to New York. And we wait for the first 15 minutes candle of the session open to close. After it closes, we mark the high of that candle, and we mark the low of that candle. Now we're done in this time frame. And for the next step, we want to zoom into the 5-minute time frame. In this time frame, we want to see a break of one of the levels. And because the higher time frame trend is bullish, there are higher chances that the market will break this range to the upside. Now when it does break, we're now done on this 5 minutes chart, and we're zooming once again, but this time on the 1-minute time frame. Here we're seeing a low time frame uptrend. It's the move that caused the upside break. Here, what we want to see is the market pulling back down to form higher lows, and these higher lows should hold this level as a support from where the market bounces up to the upside. After buying pressure comes into the market, we buy long at the closure of the last bullish candle, with the stop-loss placement below the recent lows, and we're targeting a 2.5 risk-reward ratio. Now usually we don't trade against the trend. It's easier to trade on the direction of the trend, and this market is following an uptrend characterized by already formed higher highs and higher lows. So having the continuation in mind, that would keep forming higher highs and higher lows, hopefully upwards to the take profit level. And now, let's try this on a real live market. The first step, we start on the 15 minutes time frame, and we are a couple minutes before the US session opens. I am marking the candle that opens the session with a vertical line, so it's easier to see it. So here the US session started. Now what we want to do is mark the highs and lows of the first 15-minute candle. And after that, we switch into the 5 minutes chart. Inside the 5 minutes time frame, we wait for a breakout. We have two options of breaks. It can break the high, then it will often pull back to retest the recently broken high. This is basically just a way for the market to decide if it can gather some more liquidity from buying orders so that it can later push higher. From this move, we're following with a buy-long position, targeting towards higher highs on the higher time frames. And we also have the second option, where the market first breaks down below the low. Then it should show some signs of a pullback to the upside, in such a way to gather some more liquidity so the market can decide if it can continue lower, which often does. In this case, we will be following with a sell-short position, and we're targeting lower lows. Now that you know the two scenarios and the plan for each one, we wait and see which one will actually play out. And in this case, the breakout above the high looks to be in our plan book. But we don't trade from this time frame. This is just to confirm the breakout. The setup itself we will plan on the 1-minute time frame. This is how the same price action looks like inside the 1-minute chart. We see an aggressive breakout above the highs, and now it looks to be pulling back down to retest the zone as a support. But also, if you pay close attention to the whole price action, we're seeing a simple uptrend here, with a high which was then followed by a pullback to the downside. Pullback that later breaks above the last high, forming the break of structure. And once again, a similar price action. So after the break of structure, we've had a pullback. Pullback that ends above the last low. So forming a higher low. A higher low in an uptrend is also called as a protected low, or a strong low, because in most cases it should not break. Because if it would, the market would reverse into a downtrend, and that would invalidate the uptrend scenario. And once again, a similar price action. So after the break of structure, we've had a pullback. Pullback that ends above the last low. So forming a higher low in an uptrend is also called as a protected low, or a strong low, because in most cases it should not break. Because if it would, the market would reverse into a downtrend, and that would invalidate the uptrend scenario. Now it's moving towards the broken high, retesting the zone. Here it bounced up in the short term, but it continued down afterwards. What we want to see is the start of a bullish momentum, which should be right now. Notice this candle that moved with a wick down into new lows, but it failed to continue lower, and instead it is closed bullish. Also, the next candle has a large body with small wicks. This is a continuation candle. So we're positioning the setup at this candle closure, which is the open of the next candle. Buy long setup, with the stop loss below these bullish candles, and the take profit should break above the recent highs, but also in such a way to have at least a 1 to 2 risk reward. For that, we can target higher levels, and those levels can be seen if we zoom out a bit. For example, this is the extreme high. And this high delivers the optimal risk reward with this strategy, which is around a 2.5 ratio, and now we have patience. With the position closing with a win a couple minutes later. It was actually pretty simple as long as you also understood how price action and market structure works, because like I've said before the setup, as long as we're following an uptrend, the market should constantly form higher lows, followed by higher highs, with the higher highs creating a break of structure, and after the break of structure, the higher low validates the next protected or strong low that should not break in an uptrend, and this pattern just keeps repeating. But of course, at some point it won't work anymore, and we'll take a loss, but it's not hard to catch 3 or 4 trades like this one after another while the trend is still respecting, and then taking a loss once the trend reverses, and we still end up in net positive. Now this is the Apple stock. The market here is not following a clear trend. We see higher lows here, higher highs, but also lower lows and lower highs. So if anything, this market has just entered into a downtrend, but we'll see if it can hold this trend. But before that, we need to mark the US session open and patiently wait for the first 15 minutes candle. Now we mark the high of the candle and the low of the candle, and we switch into the 5 minutes chart. Here we need to wait for a break of one of the zones, and because the market is coming from a high time frame downtrend, it's more likely that this will break the low, which it did soon after, by having bearish candle closures below the low. Now we switch into the 1 minute time frame to plan the setup. Here the market is coming from a downtrend, and lately the last candles is a retest of the broken low, which was followed with the first bearish candle that reacts down just like it would from rejecting a resistance or a supply. So being a clear rejection, we look to sell short on the closure of this candle, with the stop loss slightly above the recent internal high. And for the take profit, we can zoom out and check if we have anything that can give us a clue for an exit level. Here, for example, this might be a demand or a support where the market could fill and bounce to the upside, so we're looking to exit at this level. And here most we can, without it being too risky. It's a 2 risk-reward ratio, which is still fine. And this was actually super simple and straightforward. And again, the reason why we want to get out of the position at this demand or support is because the market has a high probability of bouncing up to the upside from this zone. A bounce that looks to liquidate one of the highs, we just don't know exactly which one. So this could have put us in a dangerous position, but by also applying market structure concepts, it allows you to manage your risk and targets better than someone that just does this strategy mechanically. This is the S&P. Now if we do a quick analysis, we're seeing that this market is following an uptrend lately, with higher highs and higher lows. The higher highs creating the bullish break of structure, which is usually followed by a pullback to the downside and a formation of a new higher high after. And when the higher high forms, there is also another break of structure. And once again, just like before, after a break of structure, we expect a pullback that should later followed with a push towards new highs, while also holding this low, being the protected or strong low. So now we mark the US session open candle, and we mark the high, and the low. And now we switch into the 5 minute time frame. Here we just wait for a break to happen, but because the high time frame trend is in an uptrend, there is a higher chance that we might see a break to the upside. And there it is. It first broke with a wick, came back down and closed below the range, but the next candle managed to close above the high. So now we switch into the 1 minute chart to find a setup. Now here, if we do a quick market analysis, we see here a swing low, then the next low is higher than the past low, the next low is also higher, and the next one higher as well. So we've got higher lows. There is also an imbalance here, caused from the aggressive push to the upside. This zone can be used for the entry level as long as the market can hold this as a support. The stop loss can be placed below the imbalance, but this is just way too dangerous, in this case being the 1-minute chart. I would look for a slightly wider stop loss. A logic stop loss level would be below these lows. Basically being right below the past low, it plays into the narrative of the uptrend where the next swing low should not break the past swing low. And the take profit, we can choose to zoom out to view more price data and zones to exit. Or if you're looking for a more simple and straightforward approach, you can just place in such a way to target a 2.5 risk reward. It's forming higher lows and also higher highs. So far a good sign since it's getting closer to the take profit. And there it is. On the Tesla stock, we see a push to the upside, then it's looking like it's trying to pull back down to form a higher low. So the 15-minute time frame follows an uptrend. We mark the high of this candle, being the 15 minutes candle that opened the US session. And also we mark the low of the candle. And now we zoom into the 5 minutes chart so we can see on a lower time frame what level it will break. Here we first got a downside break with a wick, but then it reversed back up and it broke above with a wick as well. The wick breaks are not enough. The market has to close below this low with a candle closure, or above the high with a candle closure. So far, the price is still inside the range. We will actually zoom now into the 1-minute chart, because this looks like it will break soon. And it's only now that we've got an upside break in this 1-minute time frame, and now it looks like it's trying to pull back down. But keep in mind that this candle closure break to the upside is just the upper wick break of the 15-minute time frame, so we don't actually have a very high quality break. But we can still use it considering that the 15 minutes chart was bullish. And also in this time frame, we have this massive chain of bullish continuation candles. This shows two things. It shows that buying pressure is still higher than selling pressure, so this increases the chances that we might see a buying setup, but also because of these multiple bullish candles, we don't actually see any exit level. There is no important imbalance, no demand zones, no supplies, and now the market is bounced up from the past high, showing a bullish reaction holding this level as a support, so we can now place the buy-long setup on the closure of the last bullish candle. Now the stop loss is complicated, because as I said before, there is no logic stop loss level because of this sequence of super bullish candles. So the safest positioning for the stop loss would be below the low of the 15 minutes candle, which is below this price range, and the take profit at around 2.5 risk reward. Also, because this might take a while since the targets are wider, we should switch back into the 15 minutes chart and see the progress of the setup there. So the setup is already opened, almost hit the stop loss, but then it pushes higher, eventually holding this uptrend into the take profit. This strategy alone is enough to make you profitable, but may not be enough to stay profitable. I'm sure you know this feeling of winning a couple trades and then losing them back. It's the most common problem that shouldn't be a problem anymore with the materials I've built. If that sounds good to you, take a look at the link in the description and also watch my previous videos because you can learn a lot. Thank you for watching.